please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Live from the CNBC TV18 headquarters in Mumbai.
Good morning. Welcome to Morning Call. I'm Lata and with me Anuj and Sonia. It's important that this expectation of a poll in December has almost been negated by the finance minister. You'll get to hear a lot more very important market-moving comments that the finance minister has made. But more important today will be what this message that Wall Street told us and that the Asian markets are telling us. I want to at this point distinguish between the two yield surges. Of course, we fell on Friday as well because of the global tumble, but we have to distinguish between the yield surge in the US and yield surge in India. The yield rise in the US is because of a demand pull inflation. The growth is excellent, as we saw in the wage numbers. The jobs created were 20,000 more than what the street expected, and even the December jobs number got revised higher. Even hourly wages increased, which was quite a surprise. But in our case, the yields are rising because of a fear of a cost push inflation. And that's not good. The two are very, very different kinds of yield increases. In our case, the fear is that the MSP recalculation will lead to or could lead to higher food prices, as well that the higher fiscal deficit could lead to higher inflation. You know, the fears about inflation are largely because the revenues appear to be overestimated. At least the bond market is telling you that the tax revenues are overestimated and the expenditures are underprovided. And usually these kinds of fiscal deficit lead to generalized inflation. So that is the fear. Let us make no mistake that of course we are falling because of global reasons, but we have a fundamental reason as well.
But there's good morning, Lata. Hi, Anuj. There's also a fear with respect to inflation in the US markets, right? You spoke about the wage growth. This is the first time we've seen such a big spike since 2009. Higher wages means higher prices, more inflation.
No, I'm not denying that. Yeah. It is because of inflation, but it is an inflation led by growth. In our case, it's an inflation led by higher costs.
Okay.
But Anuj, this is an extremely tricky market. For the first time, probably, since the past 18 months, I think, there is a genuine, serious likelihood of a correction. Your thoughts after 48 hours of mulling over it?
Yeah, morning to both of you. The market had, been giving these warning signs, and we've been talking about it, Lata. In fact, I remember all through the last week of December, I kept making the point that, maybe time is now ripe to just book out of mid caps and move to large caps. And look, LTCG was perhaps a trigger and not the reason for the market to fall. The markets were heavy and, maybe they needed to fall. What I believe the market could go through now is a major deleveraging process. A lot of, stocks have clear leverage. You saw a lot of that play out on Friday itself, and now with global risk off also visible, that would play out. The issue here is now how to approach the market from here on. For Nifty, I think 10,500 to 550 is seen as a huge support. You took out 11,000 so effortlessly that on the way down, 11,000 didn't act as any support. But because you took so much time to cross 10,500, 10,550 on the way up, this should act as a much bigger support for the market. And this is also the 50-day moving average for the market.
It's a distance away.
200, you fell 200 points on, so no distance is too much in the market when they start to fall. Look at Hang Seng, it's down 600 points right now. Dow was down 650 points. So, these things happen. When markets go up, it looks good. But the fall also like that.
Yes, you said 650 points down on the Dow. The last time we saw the Dow fall 600 points was the day after the Brexit vote, right? And at that point, I remember you saying that, this could be the best buying opportunity for investors, Brexit that is. And it turned out to be like that. So for longer term investors, should one look into buying quality names now? Or do you think it's too soon to make that call?
Brexit was at the start of a bull market. We were in 3 or 4 months into a bull market. So that's why, that call at that point was very easy to make. Brexit, Rexit, demonetization. Now, you are in the second stage of bull market already, and we've been all talking about why this market has not seen that 10% correction. Perhaps this is that 10% correction. I'm not saying that we go 10% because 10% would mean going to 10,200. Even then the market would be in a bull market. Look, the point here is that the mid cap index is already down 9.5% and small cap is down 11.5% from peak, and that would mean that a lot of portfolios are hurting, and this would trigger the margin calls. For today, I think you've got to divide the market in 3 separate zones. One would be 9:30 to 11, where my sense is that you would see the incremental margin pressure or problems out of that. We'll discuss some of the stocks where it could happen. Then normally by 11 a.m. that poison is taken out and you see a bit of a recovery like you saw on Friday. And then towards the end, you normally see last round of selling as well in some of these stocks. So stocks with highest open interest in few hands, these are clearly vulnerable. For investors, I think maybe at today's fall, you deploy 10%. And then, at every incremental fall, you add 10% because you will not catch the bottom. And you should not try to catch the bottom. That never works. You should not try to catch the top. So again, the market all through January gave you warning signs. And now I think the market will tell you when it wants to reverse. It will clean out this system. It will make this whole process is going to make the market extremely healthy. And once this is done, I think you'll have a big rally as well. But before that, I think you need to see some pain in portfolios, and you need to see some of the leverage out of the system, and that would happen, I think.
Yeah, I was just going to put another point on the table. Since Jan 31 is going to be the reference point for LTCG, and long-term capital gains kick in after April 1st, won't Jan 31st be a natural ceiling for all increases till March 31st? I mean, if you're in the money, you will book it now because you will not have to pay tax. So that could be a temporary resistance, a ceiling.
I have a slightly different point on that. I agree on a lot of mid caps and small caps. On that, I completely agree. But if the global markets turn sharply on the way up, in that case, you're not going to not buy or sell a stock because of the 10% irritant. I mean, if you're getting 30% from the market, the 10% is not going to worry you. But in the mid cap and small caps,
you must have a very healthy, promising bull market to reason.
Exactly. And I think the US market has given you some hint that things after a long time are looking slightly iffy, and it's across asset classes. Look at the cryptocurrency market, for example. Bitcoin is down to 8,000, and you've seen that in commodity market as well. And after a long time, dollar is rising. So far the big trade was the carry trade. Dollar was declining, commodities were rising. That trade is starting to reverse a bit. So that's
actually
also
that for me is the healthiest point.
Yes.
If dollar is weakening, I mean, even at 89, it's a little stronger than 88, but it's still a weak currency compared to others. That itself is an indication that this is a growth market. The sure sign of the end of a bull market is everyone panics and goes to the strongest currency. You don't want to be left holding a weak currency. That is nowhere in evidence. Let's be very clear.
Exactly, and just a point. Not even beginning to say end of bull market, because this is maybe we are in the second phase of bull market. The 2003 to 7 bull market had so many corrections. 10%, 20%. I think there were 3 instances of even 30% correction as well. Right. Of course, those happened right at the maturity. But in this bull market, we haven't had even a 5 or 6% correction. I think 5% has been the top. So 10% is quite natural and quite healthy. And for all of those who are saying that we'll buy on a 10% decline, maybe that decline is coming now and you want to buy. The problem is that when that decline comes, people don't want to buy. And that is why, the history repeats in markets, because the greed and fear emotions remain the same.
Yes, they do. And I take your point about growth. I mean, the numbers from the US unemployment jobs report numbers were fabulous, so to speak. Even the unemployment rate has fallen. But let's take a look at what our wise experts have to say as we head into trade this Monday morning. Matthew Hornback of Morgan Stanley says the market implied probabilities for a March rate hike increased on Friday. He says investors now place a 94% probability on the Fed hiking at its March meeting. To the end of 2018, he adds, the market is pricing 75.6 basis points of cumulative hikes.
They're still pricing 3 hikes. When you said March hike, I was thinking, I hope it's not February hike for India. No, I don't think. I don't think we're getting a hike on February 7th, but we could get a very, very strong sign that the MPC is uncomfortable with some decisions. That's what... and incidentally, that could be a cap for the Bank Nifty as well. That was the one that took it on the chin. Okay, there is more equity view for you because it's an important day. Sebastian Brown of Deutsche Bank maintains his core constructive view that low inflation growth in emerging markets can persist for several quarters. Selected curves still offer high risk neutral yields and the EM Forex has room to appreciate. He, however, adds, but after such a strong rally, Deutsche Bank expects more gradual gains and increased risk of temporary technical corrections.
Okay, and let's get you some money market news as well, because that's going to be important for today. Pramit Brahmavat of Veracity says positive data from the US economy will keep the dollar stronger. He expects the dollar INR pair to trade in a range of 63.80 to 64.20 for the day.
Okay, on bonds, Ajay Manglunia of Edelweiss says volatile swings seen post the budget are expected to persist till the MPC review this week, on Wednesday that is. He adds, as with the last couple of sessions, the 10-year benchmark bond yield is likely to trade in a wide band of 7.5 to 7.65 today.
Okay, the big talking point this morning, of course, is the global setup. Dow fell 665 points on Friday. Here's Nigel with the world view.
Well, the Dow fell 665 points in Friday's trading session, and that was the worst fall we saw in a single trading session all the way since Brexit. You know, if you just take a look at it, these US markets, they were on a bit of a winning streak. Now they have snapped that 4-week winning streak, and in fact they ended in the red. But what's really telling you the picture is the CBOE volatility index. Now that's surged up. I remember trading at around 11.5. It's moved up all the way to around 17, and in fact a 28% surge in a single trading session. A lot of those blue chip stocks as well did come in for selling pressure. Apple came out with a good set of numbers. That got sold into. Alphabet as well did take a sharp knock, both of them down between around 4 to around 5% in a single trading session. But in terms of a biggest fall in a single trading session, well, the S&P 500 as well as the Nasdaq, they saw their biggest falls in the last 6 months odd in a single trade. The other factor was the bond yields. They have been surging up. Just in November, it was at around the 2.3%, 2.35%. Now it's moved up to around 2.87%. So that's not very good news. And if you take a look at the jobs report, well, that was very, very strong. You know, the total jobs added were way more than expected. Even the wage hikes, that as well was better than anticipated. European markets, they ended in the red. What was the culprit of there? Banking stocks. Deutsche Bank came out with a set of numbers that got sold into. In fact, it dragged down other banks as well. And early this morning, the Asian markets, they're under big pressure. The Nikkei, the Kospi, we have a couple of data points that are coming in from there. The Japanese composite PMI, that looked better. Chinese services data as well looked good. But all that is being ignored. And that's what's telling you the SGX Nifty is likely to start off with a cut of around 110 points. Back to you.
Thank you very much, Nigel, for putting all those indices that we should be keeping on our radar. As you have pointed out, the big story this morning is the global sell-off. Where do things head from here on, both for Indian markets and for global markets? Richard Harris, Chief Executive, both Shelter Investment Management, and Albert Lung, of AEJ Rates strategist at Nomura, join on the phone line. Sorry. Good morning, gentlemen, and thank you very much for making this unscheduled stop. This was an unscheduled fall as far as we are concerned. Richard, first to come to you. This fall is still because there has been very good growth data. So do you think that both in EMs and in the US, the fall will be bought?
Sorry, could you repeat the question again?
No, I mean, the fall in equities is largely because growth was very good, and that's why you saw the spike in yields. Therefore, is there a chance that investors will return very soon to buy the dip in equities, both in the US and in EMs?
Well, I think, you know, that's likely to be the case because we're not in bubble territory, although we have had a very sharp rise in the markets. Indicators are still not too stretched, but it has gone up for a long time. We are due a pullback, and let's face it, a pullback of 2.5% doesn't take us anywhere near year-end starts. So I think what we're seeing is entirely consistent with finally the market saying we have to pull back. It's looking for some excuses. Interest rate rising is an excuse. The growth perhaps leading into interest rate rises is another excuse. So I really see it as just a normal movement in the market that you'd see at this stage.
Okay, normal movement in the markets. Richard, good morning. So what do you expect as far as the rate hiking cycle is concerned? Are we looking at a March rate hike from the Fed and the new chairperson? And if yes, do you expect to see any further jitters in the market?
Well, I do see that. We'll have to see rise from the Fed. You know, we're looking at 3 this year. I think that's reasonable. Of course, we have a new Fed chairman in, and in fact, 3 new senior members of the Fed board have come in. So there's every likelihood we are going to see these rises continue. We might even see more rises happening, although it does look as if Governor Powell, who has taken over from Janet Yellen, is likely very much to follow her view or her move, which was rather stable. But it so often happens that you have a new person come in that they're faced with a new series of challenges and issues. So who knows where it may go.
Okay. Richard, good morning. We may not be in bubble territory, but we had a huge rally, especially in the last quarter of last year. So you think this market needs to give up some more gains before buying resumes?
Yes, I do. I think that, we saw something like 6.5% on the Dow in the last quarter. We saw nearly double digits in Europe in the last quarter. So, losing, what have we lost, maybe 3% or so off those highs, is that not that high? It's quite reasonable. We might even see a double-digit pullback if the market feels that the news is a bit worrying, if we have some troubling stories about the long bond moving up and some troubling stories about companies moving into debt. All of these things can happen. But I do think we probably are in a dip scenario where you could buy. I suspect it's a little bit too early to trade it just yet. All
right. Albert Lung is also with us, the Asia ex-Japan rate strategist at Nomura. Albert, the entire EM basket, tell us, which of the bond markets are worth buying? And what about India in particular, where the yield surge began much before the US yield?
Yeah, good morning. So yeah, obviously, I guess the U.S. rate sell-off has, taken the market by a little bit of surprise, right? Especially as typically, if you have a big decline in the equity markets, you will have expected some safe haven flow into U.S. bonds, but it didn't happen. So in fact, the U.S. curve actually bears steepened. So I think that it is partly, of course, because of the very strong and non-farm payroll, in particular the wage growth. So basically what the market is pricing right now is about 3 hikes this year. But beyond this year, the amount of rate hike price is still quite shallow. So the market seems to be increasing the risk premium on that front. And also from the second quarter onwards, the U.S. Treasury will be increasing the bond supply. So it comes at a time when we talk about tax cuts, increasing the burden on the U.S. budget, and also maybe some foreign central banks starting to buy a little bit less Treasury. So I think all this is added up. So overall, right? So you asked about the implication on
India.
Asia bond market. And also India. So first of all, the Asia bond market. So Asia bond market, we actually expect the curve to steepen in Asia because we think that the long end bonds will be more sensitive to the U.S. bond yields, whereas the front end is still more a function of regional monetary policy. Yeah. And we don't expect Asia central banks to hyper aggressively in this year yet. So that's for Asia. But as for India, we are currently have a neutral stance on bonds. So as you say, that it has sold off a lot already. But so it may actually, from a pure level perspective, there may be some value. But what we think is that we want to see through the RBI policy meeting this week first, because the bond market has reacted quite negatively to the budget. Yeah. Okay. And so we want to see if the RBI would interpret the budget as inflationary first. Okay. So at the moment we are fairly neutral on the bond market at the moment.
Okay, fairly neutral on the bond market in India. Thanks, Albert, for joining us. Richard, just leave us with your view specifically on the Indian market, because we've seen a huge sell-off. Of course, not as bad as what we've seen in developed markets, but do you get a sense that emerging markets like India could continue to underperform some of the developed markets going into the rest of the year?
I don't. I think that where we are in the cycle is the time of the cycle when the emerging markets tend to do quite well. You know, we've got Europe and Europe's recovery doing reasonably well. I think it'll be positive for equity markets there. And it's also the time of the market when you often get some rotation of assets from developed market investors through into emerging markets. So I think that there's still likely to be some element of fund flow pressure throughout the year and throughout the part of this cycle. And that's the kind of model that you hold to if you have the kind of roadmap that I have, which is, yes, this is a dip. It might be quite a sharp dip, but we're not yet at the end of the cycle. We're not yet in bubble territory where we're going to have a big crash. So I think this particular bull market is likely to continue, and that would favor emerging markets, commodities, commoditized markets, and also one or two lagging markets that haven't quite followed through.
Okay. Good to hear that, Richard. When the Asian markets are a sea of red, good to hear a voice of some optimism. Thank you very much for joining us. Well, the important point for India is not just the yield jump and the global risk off, but the fact that crude can make a crucial difference to us. That's the silver lining. Finance Minister Arun Jaitley spoke to the CEO News of Network 18, Rahul Joshi, on exactly these challenges thrown up. Listen in. We're going to play you lots more of that conversation.